Hey, this is Bert Salazar. I'm hoping that all of you are doing well. I always say that the definition of insanity is to continue to do the same things over and over again while expecting a different result. And sadly enough, the vast majority of Americans continue to do the same things, and then all of a sudden they find themselves in international waters on a dinghy with no paddles. I think it was sometime around March 19th or March 20th of this year, 2020, that the Dow Jones was down due to the epidemic and the pandemic that we're going through was down somewhere in the 19,000 range. And at that time, I did a podcast and I did a video that you have to start thinking outside of the box, especially when it comes to your retirement accounts, because as you all know, when you put money into a qualified plan, a retirement account that is qualified in nature, the money that you put in is pre-tax and money grows tax deferred. But then when you pull the money out, you have to pay taxes on the whole thing. And the challenge with that is that when you are deferring the tax, you're also deferring the tax liability. So, we all know where taxes are going to be in the future. They're going to have to be a lot higher than they are today. And because of the fact that during your working years, you have the ability to deduct a number of things, by taking deductions, exemptions, and credits while you're working. Once you're retired, the rules of engagement totally change. And a lot of those deductions and exemptions and credits that helped you while you were working are no longer available to you. So even if taxes were not to go up, your tax liability, your personal tax liability may definitely go up because of the losses of those deductions and credits and exemptions that I have just talked to you about. So I did recommend at that time back in March that if you start thinking outside of the box, one of the things that you may be able to do is start to convert some of those retirement accounts that you have in your forever taxed bucket to the tax-free bucket through Roth conversions. And then depending on your tax liability and what you can afford to pay in taxes from one year to the next, you could start doing those Roth conversions. So now the growth of those assets would be tax-free for the rest of your life. So obviously over the last, I think it was 4 weeks or so, the market has recovered somewhat up until last week, because last week the market dropped over 1,800 points in one day. But by the same token, the market went from like 19,000 to about 27,000 points. Now, when it comes to the points, that's just the Dow. Your individual retirement accounts may have done better or may have done worse, depending on where you invested your money and what your asset allocation looks like. But if it follows the trend of the market, then from 19,000 and change to 27,000 and change, all that growth would have been tax-free for you if you had done a Roth conversion at that point in time. So it's important to stay ahead of the game because you have no control what the market is going to do. So therefore, it is critically important for you to be very active when it comes to your retirement accounts. Now, I know you don't have to tell me this, but the vast majority of financial advisors that you're working with, they're not making these money moves on your behalf. They're not even advising you on that, because all they're doing is gathering your money, gathering assets, and putting them into a portfolio. And perhaps if you're dealing with a good advisor, once a year you get to review it, but they're not proactively managing the assets in that portfolio and not only help you create a balanced portfolio and proper asset allocation, but also help you create tax allocation. I'm going to share my screen real quick with all of you because it's something very important that I want to share with all of you that I think is going to bring my point home, and it's also going to share the importance of making certain that you're being proactive, not only from an account management and asset allocation standpoint, but also from a tax perspective. So let me take you to this slide right here, which shows the S&P 500 over the last 20 years. And I want to, although I cover some of these topics in my webinars and my podcasts and so forth, I just want to take a few minutes of your time and just share this with you. If you notice, in 2000, the market was at a very high level at that point in time, March 25th of 2000, and it actually peaked at a very high level. But then over the next 3 years, when it goes down to 2003, notice that the market was down 49% over that 3-year period. Now, it took up until 2007 for the market to actually get back to where it was in 2000. So there was a 7-year window of opportunity where you actually make no money, because the market peaked in the year 2000 and it got even again in 2007. So that V shape of losses were really detrimental for you and your family from a return standpoint and asset allocation standpoint in between 2000 and 2007. Now, can you imagine if you would have been in retirement at that point in time, and all of a sudden you're seeing your account losing value every single year? But by the same token, now you have to invade principal and interest because you have to be able to maintain your standard of living. You would have never been able to recover. But if you were still working and you allowed that the market and your account value to recover, then all of a sudden you get to 2008, and look what happened between 2008 and 2009. So this is becoming a roller coaster of investments and rates of returns and gains and losses along those lines. And notice that between 2008 and 2009, the market was down 57%. Again, can you imagine if you would have been retired at that point in time? And then it actually took until 2014 for the market to recover, for the S&P 500 to recover. So again, from 2008 to 2014, it took about 6 years. Always remember, if you have a 40% loss on any given year, it takes a 67% rate of return just to break even in 1 year from that loss. But even if you're trying to get like an 8% rate of return and you're able to get that 8% rate of return on a 40% loss in year one, it's going to take you, I think, it's 6.6 years for you to break even and catch up to where you were 6 years earlier when you dropped 40% in the market. So managing the peaks and the valleys of your retirement accounts is very, very critical. By the way, there are accounts that, if you do it the right way, that do not have any valleys. All you would have would be peaks. So for instance, if you invest in a fixed index annuity, you would have stayed in 2000 when you were at the peak, although the market dropped 49%. And then as the market started to recover from 2000 and 2003 until 2007, then you would have continued that upward trend without losing any money whatsoever, because you would have stayed where you were at in 2000. And then the same thing would have happened in 2008. If the market dropped 57% between 2008 and 2009, you would have stayed in the S&P 500 at the 1,565 points, because you would have never lost any money. When you're dealing with fixed index annuities, always remember that zero is your new hero, because the worst thing that you can do is not get a rate of return for the year, because the insurance carriers are providing these products are going to be assuming the liability. Now, they'll participate with you in the gains, but they're assuming 100% of the liabilities. So you wouldn't have to go through the peaks and valleys and then try to time the peaks and valleys when it comes to your retirement distribution planning, because once you're in retirement and now you depend on those retirement assets 100% of the time, then whether there's a peak or a valley, you're going to have to invade principal and interest in order to maintain your standard of living. And if you're doing so during a valley, then chances are you're going to run out of money way before you thought you would, and you're always going to run out of money before you run out of life. The second slide that I want to share with you, this one I just printed this morning. So as of this morning, we have a national debt, as you can see there on the top left-hand corner, of $26 trillion. That's an enormous, we've never had that kind of debt in the history of this country. Now, the pandemic and the COVID-19 and all the money that we're printing and giving out to Americans has actually increased that debt significantly as well. Under President Obama, we actually went from 10 trillion to 20 trillion in a matter of very little time, because it doubled at that point in time. So I don't care if you're a Republican, I don't care if you're a Democrat, everybody owns this debt, and they're all responsible for this debt. So when I look at economics, I don't pay attention to one side of the aisle or the other, because actually I blame both from that perspective. But here's what's interesting. If you take a look at in the middle of the page where it says U.S. federal tax revenue, this is all the revenue that the U.S. government is generating on an annual basis. The revenue so far for the year, and we're in the middle of 2020 right now, is at $3.2 trillion that is coming in. But then if you go to the left, right, next where it says U.S. federal budget deficit, we're actually spending right below the national debt, we're spending $6.3 trillion in 2020. So that means that we're bringing in 3.2 million, but we're spending out 6.3. How long do you think that's going to last? Because right now we have not only a national deficit of 26 trillion, but we have a budget deficit on an annual basis right now of $3.1 trillion. How long do you think we're going to be able to do that? How long are we going to be borrowing from Peter to pay Paul? Because everything is fine until Peter runs out of money, and Peter has already run out of money. We're just printing bad money after bad money in order to cover those gaps and liabilities. So you have to start thinking outside of the box. You know, the government is going to have to raise those taxes to make certain that that federal budget deficit, that we can even it up at some point in time in the future, and that we can start to do something with the national debt, which is now at $26 trillion and counting. So you have to start really using your retirement accounts in a strategic format, and making certain that you put pressures on your financial advisor, you put pressure on them to make certain that they're doing the job that they're supposed to be doing for you. Because otherwise, you know, you might as well reach out to me and call me, because I'll be doing that job for you, where the vast majority of these advisors are not going to be doing that. So you have to make certain that you can manage a sequencing or return, which is what we covered in the previous slide of managing the peaks and the valleys, and hopefully get rid of the valleys altogether in all your retirement accounts. But by the same token, you have to manage the taxation of those accounts. And the only way to do it is you have to take assets little by little from the forever tax bucket to the never tax bucket again, from an IRS standpoint. So you're going from the tax deferred accounts to the tax-free accounts, which will include your Roth IRAs, your Roth 401ks, your 7702 plans, which are cash value life insurance plans, and then obviously municipal bonds as well. So you have to do your due diligence and be proactive. Don't be just sitting around, you know, waiting to see what the market is going to do from one day to the next, because at least you can control the returns from your investments if you do it the right way. And then the last final slide that I want to share with you today is this is the one about the unfunded liabilities. And for those of you that may not know this, the unfunded liabilities in the United States are those promises that the U.S. government has made to all of you, all of us, including me, that they're going to be able to provide for us. And that would be the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt. If you look out toward the bottom right-hand corner, notice that the U.S. unfunded liabilities are now sitting at north of $148 trillion. And that's going up every single second of every single minute of every single hour of every single day of your life and my life. So how do you think the government is going to solve this problem? Now, we all know that taxes are going to get higher January 1 of 2026, because the Tax Cuts and Jobs Act under the new law will sunset December 31st of 2025. So where do you guys think that taxes are going to be in the future? Let me stop my sharing at this point in time. So at the end of the day, what I try to do with a lot of you is not only to provide you with information, but most important, I want to provide you with education, and I want to give you the tools that you need in order to make the right decision at the right time, for the right reasons, and under the right circumstances. And because at the end of the day, it is your money. And if you allow the government and the financial institutions to control your money, then chances are you're not going to be very successful in your retirement life. Now, if you want to have a conversation with me regarding this topic or any other topic, please feel free to reach out. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for you and your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, have a great week, and I'll talk to you soon. Take care.